Hello, and in this unit we will be discussing renting versus buying, what the pros and cons are, and the costs. Many people make many decisions in the process of acquiring a place to live. The process refers to the method used to accomplish a task. Housing decisions are a part of a process beginning with the decision to rent or buy housing, followed by a determination of how to pay for the housing choice and moving. Additional decisions are required later for the operating of the unit as well as replacing and adapting it through time. In thinking about the process of acquiring housing, can you describe how your family acquired the housing in which you live? Was it purchased or rented? If purchased, was it new or pre-owned? Was the housing built for a previous owner or for your family? After choosing to either rent or buy, you will make additional decisions in the process about how to operate and maintain the housing. You need to make arrangements to have the water, electricity, and/or gas turned on. You need to arrange to move your belongings to the house. You also need to repair or replace parts of the dwelling from time to time. Repairs may involve something as simple as replacing a worn seal in a leaky water faucet, or something as complex as adding a second floor. You will need to decide how to pay for these housing expenses. You can pay for expenses in the following ways. Pay the full amount with cash, check or transfer the funds from another account or debit card, postpone payments by using a credit card, or pay part of the total now or make a down payment to secure a purchase. Then you can pay the remainder in regular installments. When deciding on renting, there are pros and cons. Renting means paying money to live in a dwelling owned by someone else. There is a landlord, that is the owner, and a tenant, that is the renter. About 1/3 of all people in the United States rent their housing. The majority of these people are single people, young married couples, or older adults. Many in this group have mobile lifestyles. The terms renting and leasing are almost identical in the meaning that they both refer to the use of residential property for a specified time. There may be a slight difference regarding the period of time. Renting can occur on a more flexible month-to-month basis and can be accomplished through oral communication or through written rental agreements agreed on by both parties. Leasing generally refers to a set period of time also, but usually for longer time periods than some rental agreements, such as 6 months to a year, and definitely involves a lease. A lease is a legal document signed by both parties that spells out the parts of the rental agreement. Renters usually pay for their housing in monthly installments. When they first move into a building, the owner or building manager usually requests a security deposit in addition to the first month's rent. The security deposit is a payment that insures the owner against financial loss caused by a renter. For example, the renter may damage the property during his or her tenancy. Part of the security deposit would be used to pay for the damage. The amount of the security deposit commonly includes 1 month's rent and may include an additional amount. Renting has a number of advantages. Renters have more freedom to relocate as they desire. They do not need to worry about the value of the property going up or down, or buying or in selling. They have a clear idea of what housing will cost them. There are no hidden costs such as roof repairs that often comes with ownership. Since renters do not own the dwelling, they do not need to budget money for maintenance and repairs. These are the responsibilities of the building's owners. Some of the disadvantages of renting is that there are limited control and freedom, such as little to no control how the building is maintained. You need to ask for permission to make decor changes, such as painting or wallpaper, and may limit or prohibit pets. There's a lack of permanence where you don't have the ability to move in and out frequently. Neighbors feel like strangers. And then the financial side. Money spent on rent does not go towards an investment. Rent may increase after the initial lease terms end. In this section, we will look at the pros and cons to buying a home. Needs versus wants. When considering the costs associated with acquiring housing, it's important to know the difference between housing needs and wants. Needs are basic necessities, while wants are things that you desire. Wants almost always cost more than needs. Sometimes people have wants that cost far more than they can afford with their current incomes. For example, first-time home buyers who want the home of their dreams need to align their wants with what they need. In reality, they only need adequate shelter that protects them from the elements. As they search for housing, they will likely find what they want is not what they can afford. They must examine their priorities and identify which of their preferences they can afford. It is a good idea to determine in advance the amount to spend for housing and then refuse to go over that amount. When buying, there are about 2/3 of people in the United States who own their own houses instead of renting. These people prefer to buy a house and stay in place for several years. House ownership has many advantages. It provides a sense of freedom. For example, homeowners know they have a place to live. Eviction is not likely unless they fall behind in their house payments. Also, they can make decisions about their housing and do not need to depend on another person, such as an apartment owner. Financial advantages also exist with the house ownership. A house can be a hedge, something that provides protection against inflation, which means that the house probably will increase in value at a higher rate than the rate of inflation. People who pay rent must make higher payments for the same housing inflation rise. Depending on the condition of the economy, houses tend to increase in value over time. As the value of your house increases and make payments on the principal, which is the original sum you borrowed, of the home loan, you build equity. Equity is the money value of a house beyond what you own on it. Renters are not able to build equity on their housing. Homeowners can gain equity if they sell or refinance their house. House ownership also provides a tax advantage. The federal government permits deductions of annual real estate taxes on a house and the interest paid on the home loan. Some states allow these deductions too. Although there are many attractions to home ownership, it's not just for everyone. Buying a house is a complex, time-consuming, and costly process that brings many ongoing responsibilities. Continuing on with advantages of home ownership, there means good credit. Having good credit can help owners build good credit can negatively impact credit score if regular payments are not made. Tax advantages on income tax savings, such as interest, is a tax deductible, and property tax is also tax deductible. The disadvantages of home ownerships would be that you can usually expect to pay more on your housing per month than you did in rent, at least for the first several years. Even if your house payments are less than you paid previously in rent, you must pay property taxes, homeowners insurance, utilities, and maintenance expenses. Some of these unexpected expenses could be water heater replacement, roof leaks, broken appliances, along with needing to spend time on maintenance, such as snow removal, lawn care, and painting. There's also roof replacement and or fireplace care. When there's limited mobility, that means long-term investments can be costly to sell a home shortly after purchasing. Usually you want to live in an owned home for 1 year minimum. Another possible drawback to home ownership is the potential for foreclosure on the home. Foreclosure is a legal proceeding in which a lending firm takes possession of the property. This occurs when borrower fails to make monthly payments on a timely basis or does not fulfill the agreements related to the loan. The agency that lent the money to buy the home may take the property and sell it. In this section, we will take a closer look at costs, a renter's cost and a buyer's cost. You must examine your finances. Buying the right house is not a simple task. You want a house that makes you feel comfortable and happy. It must also be the one that you can afford. When it comes to the renter's initial costs, which include application fee, credit check, security deposit, pet deposit, that's only if you are bringing a pet into the home, advance rent, which is on occasion, and or moving costs such as movers, trucks, and boxes. Things to consider and ask the unit owner following questions would be: how much is the rent per month? How and when is it to be paid? Is there the security deposit required? If so, how much is it? Under what conditions will it be returned? Will rent increase if real estate taxes or other expenses rise for the property owner? What are the expenses such as fees besides rent? These may include utilities, storage space, parking spaces, internet and TV services, use of recreational areas, installation of special appliances and or late rent fees. Also, are there loud noise prohibited at certain hours? Normally is between 10 and 7 a.m. Be sure to obtain complete answers to each question and make sure you are happy with these answers. You want your housing to bring you satisfaction, not frustration. Continuing on with renters' costs would be rent, renter's insurance, utilities, and parking. So a rental amount, this is the section that should be included for cost and rent and when and where it should be paid. It should also include the penalties if there's any late payments. A security deposit, this is whether a security deposit is required at the amount when moving in. It should be also identified in the conditions the house is and how to gain that money back when you leave your rent or your apartment. Utilities. Paying utilities such as water, electricity, gas, and recycling and waste pickup. If you are responsible for payment, please ask to see a record of the previous billing. Special considerations. Assigning or subletting a lease. If you have signed a lease but you wish to move out early, you have the following of 3 options. Continue rent payments until the lease expires, assign the lease, or sublet the lease. To assign the lease, you transfer the entire unexpired portion of the lease to someone else. After the assignment is transacted, you are no longer held responsible for the lease. To sublet the lease, you transfer part of the interest in the property to someone else. For instance, you could turn over the apartment to another person for a period of time. Both of you or the other person would be responsible to the landlord for all times of the lease. If you do not prefer any of these options, talk with the landlord to see if there's an option exists for you. Most states have laws to protect renters. Usually, renters can pay to get out of a lease, sometimes 3 or 6 months' rent. Becoming familiar with the laws of your state before talking to a landlord. When it comes to the buyer's initial cost, there is the earnest money, and that is a deposit paid to show an interest, which is also seriousness of purchase. And this could be upwards to 20% down on the initial purchase price of the home. An application fee, which that is kind of an out-of-date term because they don't do application fees anymore. It's kind of all encompassed into when buying a home. There's a credit check fee, and that is done through your mortgage company. inspection fees, down payments, which is again that 5 to 25% of the house cost, closing costs, movers, trucks, and boxes. When it comes to the costs in buying a home, you want to buy the right home, and that's not a simple task. You want a house that makes you feel comfortable and happy. It also must be a home that you can afford. The ability to afford home ownership begins with the realistic assessment of your own finances, your income, the size of your savings account, and your debts. Most people do not have the cash to buy a house outright and must borrow a substantial amount of money. The financial institutions you will choose will make the ultimate decision about your ability to buy a house. So the mortgage payment consists of anywhere between 10, 15 years, or 30 years. There are property taxes, homeowners insurance, utilities, and maintenance. The people involved in the home buying process with you are the appraiser, and that is a qualified professional who is certified to evaluate real estate property and determine to the fair market value. An attorney, a borrower, which is your mortgager, and this is a person who borrows money to buy a home. The person pledges to repay that money with interest and maintain hazard insurance on the property. There could be government program representatives, home buyer counselors, home inspectors, homeowners insurance representative, the lender, which is your mortgage company. A lender is an institution or person that lends mortgage money and uses the property as security for debt payment. There's also loan services, mortgage insurance, and that is an institution that insures the lender against loss in case the borrower defaults on the loan. This private mortgage insurance, such as PMI, is usually a requirement when the home buyer has a down payment that is less than 20% of the appraised value. Finally, there are the real estate professionals, and that is your person licensed to negotiate and complete the sale transaction of the home that you are purchasing. The broker or agent may be an exclusive buyer agent, one who works only with the buyers, or a seller's agent, one who works only with the sellers. Some brokers or agents do both. Finally, a company representative, a title company representative, and that is a person who arranges for title search, disbursements of funds, and legal transfers of the property ownership from one person to another. Now, I want to continue on just a little bit with the buyer's continual cost, as there are 3 general guidelines for determining the price range of a home you can afford. One of the general rules for estimating a house affordability are that estimate what you can afford, gross income. So the other 2 guidelines examine your current expenses as ratios to determine how much your income can go toward a house purchase. These guidelines provide a fairly clear picture of what house prices are best for you. So estimate what you can afford. One way to quickly determine the price range you can afford in buying a home is to use a simple rule. Multiply 2.5 times your annual gross income, or income before tax deductions. This provides a general idea of the maximum house price you can afford. If you have an annual income of $50,000, for example, you should be able to afford up to $125,000 for a place to live. Though this rule is only for measuring house affordability, it provides just a ballpark figure. A lender will take a closer look into the account of other debts and responsibilities to becoming a homeowner. You also have housing to income ratio. Your monthly housing costs should total no more than 28% of your gross monthly income. These housing costs include the house payment, property taxes, insurance, utilities such as gas, water, electricity, repairs, maintenance, and cooperative or condominium fees if applicable. To obtain your housing to income ratio, divide your total housing cost by gross income. Then multiply your decimal result by 100 to obtain the percentage. Then there is the debt to income ratio. The second guideline compares to total monthly debt to total monthly income. Your monthly housing costs plus other long-term debts should total no more than 36% of your monthly gross income. Long-term debts are those debts that will be 10 or more months to repay. Then, to obtain your debt to income ratio, divide your total debt plus housing costs by your gross income. Then multiply the decimal result by 100 to obtain the percentage. If you meet these ratios, you will probably qualify for a loan. These ratios may vary slightly depending on specific type of loan. Other factors also include into the decision to receive a loan to buy housing. A major factor is the credit history of the potential buyer. The credit history of a person includes past payment record and a profile of outstanding debts. The credit history includes a person's credit score. A credit score is a complex mathematical calculation that evaluates the information on a person's credit history. Lenders use this information to determine whether a person qualifies for a particular form of credit. There are 3 consumer reporting companies keep monitor on a person's credit history. There is the Federal Trade Commission, FTC, which requires nationwide consumer reporting companies such as Equifax, Experian, and TransUnion. Those are your 3 credit reporting companies. To provide a free in order to provide a free copy of a person's credit report at his or her request, you can only request this once every 12 months or a year. The credit reports include the past payments record as well as a profile of outstanding debts. The credit history gives a bank or other lending agencies information about whether a person is likely to repay a loan. People are considered high risk if their credit history indicates frequent late payments and high debt.